Suddenly price fails to make a new low and starts forming higher lows. Then price breaks above the trend line, signaling that buyers are stepping in. This is our opportunity to go long. But here's the key. A trend line break alone is not enough. We need extra confirmation to make sure it's real. This is how you avoid false breakouts. A double rejection pattern happens before the breakout and gives us extra confidence that the trend is about to reverse. As you can see, the market is trending up. But suddenly, it fails to make a new high and forms a double top. This tells us that buyers are struggling and that a reversal could be coming. When price breaks below the trend line, we now have two confirmations: momentum loss and a trend line break. This is a strong sell setup. Look at another chart. The market is trending down, but suddenly, it fails to make a new low and forms a double bottom. This shows that buyers are stepping in to defend support when price breaks above the trend line. We now have confirmation that a reversal is in play. This is a high probability buy setup. By waiting for this extra confirmation, we avoid getting trapped in weak breakouts. Until now, everything is going according to plan. But we must not forget an essential component of the strategy: multiple time frame analysis. Let's break it down with a real example. As you can see here on this 5-minute gold chart, the market has been trending upwards, and we've identified a well-defined trend line. Now what happens next is critical. The market breaks below the trend line. But before we jump to conclusions, let's take a closer look. If you check above, you'll notice two key signals: a double top pattern and a clear liquidity sweep. Here's what happened. The market broke above this level, but immediately closed back below it. This move was designed to grab liquidity, trigger stop losses, and then reverse direction. The trendline breakout confirms the trend reversal. But we need one more step to increase our confidence in the trade. Let's zoom out to the hourly time frame to see if the bigger picture aligns with our 5-minute chart and the hourly chart. We find even more confirmation. The trend line has also been broken. Another liquidity sweep occurred at the double top just before the breakout. But here's something even more significant. Check this out. We now see a clear order block. Once it was broken, it turned into a breaker block. Now look at the price action. When the price retested this breaker block, it was rejected. The rejection candle engulfed all previous candles, signaling strong bearish momentum. With the hourly time frame confirming a bearish outlook, we return to the 5-minute chart. Now that we have alignment between the higher time frame and our trading time frame, we can execute the trade setup with confidence. Place your entry at the close of the bearish candle that confirmed the rejection. Set your stop loss just above the wick of the rejection candle. Aim for the next support level, ensuring a 2-to-1 reward to risk ratio. By aligning multiple time frames and incorporating key market signals like liquidity sweeps, breaker blocks, and engulfing candles, this trade setup becomes a high probability opportunity. Stick to the process, trust the strategy, and let the market do the rest. Now that you understand the strategy, let's talk about a crucial step that takes it to the next level: top-down analysis. This approach is essential because it ensures that your trades align with the broader market context, increasing your chances of success. Whether you're scalping, day trading, or swing trading, here's how it works. If you're trading on the 5-minute or 15-minute time frame, your higher time frame is the hourly chart. You'll use the hourly to spot the overall trend and key levels, and then refine your entries on the lower time frame. If you're a day trader working on the hourly time frame, your higher time frame is the daily chart. The daily chart will help you identify the bigger trend and key zones that the market respects. For swing traders trading the 4 hours time frame, your reference is the weekly chart. The weekly gives you the broader perspective needed to hold positions with confidence over several days. And if you're someone with limited time trading, the daily time frame. Your higher time frame is the monthly chart. This lets you focus on long-term trends and make informed decisions without constantly monitoring the market. That's it for this video now. You know how to trade trend lines effectively using confirmations,